Feels like it's been a while since I've done a webinar, but I guess it's only been a month. So welcome everyone. My name is John Vance, president of Vance Wealth. I will be your host and presenter today. I'm going to go through kind of a year-end review and give you some thoughts as we go into next year. I'm really excited about this, but I have to warn you ahead of time. There's a lot of content around markets and numbers and stuff that I get excited about. But it's a little on the heavy end, but I think it's going to be pretty fascinating, some of the slides I put together, so I hope you enjoy it. As always, from a housekeeping perspective, there is a Q&A tab at the bottom. Go ahead and type your questions as we go through, and I'll do my best to answer them. If there's any that I can't answer, I'll address those offline. One of the things just to remember from a disclosure perspective, we want to make sure that as we start going through some concepts or even some conversations, just know that what we cover, this is kind of designed to be broad-based. Everybody's individual investments are different. Everybody's individual portfolios are different. And I think it's just really important to recognize that as we go through some of these concepts. If you have questions on how this all applies to you or how Vance Wealth is managing this for you, that's really a one-on-one conversation for your advisor, and we're happy to answer those questions. But today is more broad education, so I hope you enjoy. So let me go ahead and share my screen and we will get going. All right. So the topic for today is learn from the past and make more disciplined decisions. So that's going to be kind of the little bit of the nuance of what we're going to cover today. So I'm going to get a little pointer here so I can kind of follow along with our conversation today. So of course we have disclosures. Vance Wealth is a registered investment advisor, and this is the advice of John Vance. So you can see this disclosure for later if you need to. All right. So one of the things when you start thinking about investing is so much about psychology. And unfortunately, many aren't really equipped or wired to make disciplined investment decisions. And this was a great year to reflect back and really see the emotional pieces around investing. One of the things that I would just like you to kind of think about this for yourself is if we could go back to January and we just start thinking, okay, we're planning for the year ahead, and let's presume we actually knew what was going to happen. We knew that that COVID would become an issue, that we would have the economy shut down. We would go through lockdowns starting in March, that the economy, for all intents and purposes, was mildly shut down in some places and severely shut down in others for the better course of the entire year. What investment decisions would you have made? If you would have known that that was what was going to happen, what decisions would you have made? Now, I've posed this to a lot of clients and they kind of, jokingly say, well, I would want to get out of the market because that can't be good. Yet as we sit here, the stock market is up about 15% year to date. And so that's one of the things that makes investing a long-term objective or a long-term game, is that even when we know what might be happening with the economy, with the world, that doesn't guarantee what the outcome is going to be, right? Because conventional wisdom would have told us that, this would have all been terrible for the stock market. Now, we did have a terrible run from the highs in March to the lows in May, where it was extremely severe. The government came in and provided unprecedented support to really get us back on track. But that's a really important reminder when you start thinking about looking at being an investor, is that even if you could go back and use, our crystal ball, the outcome that you would have expected was probably not the outcome. And that's what makes planning, that's what makes predicting impossible. Planning is not impossible. Planning, you can be very thoughtful. Predicting is impossible. And so these are just kind of a samplings of what I call kind of natural instincts. We all have this sense of like, I know what's going on in this industry. I should make a better decision. Or, the markets have tanked and I should have seen it coming, right? We have these mental errors, but that's why we try to have a really healthy focus around being disciplined, investing your money to your financial plan, because a lot of these things, most of these things are totally out of our control. And we have to take this longer term view and kind of ignore the noise. And so I actually look at this year for many investors is going to be that year that really helps to solidify discipline, because we really have run the course of emotion. And this is a great year to then say, you know what? I survived this. I stayed invested. I know this is going to be normal going forward. Now, whether it's COVID or early on in my career, we went into Iraq. That was back in 2003. The markets didn't like that. There's always some reason to be skittish. There's always some reason why the markets aren't going to move forward. And, I guess that's a little bit of optimism that I have, is that I think over time, generally, prices of real estate are going to go higher. Generally, prices of stocks are going to go higher. And we just over time, and that's built into our economic system, because we have inflation built in and we have a growth mindset, growth mentality. So the mental errors that face, now we kind of have a badge of honor that, we look at this past year, we didn't have clients go to cash. We were able to kind of ride through the storm, and now we're coming out of it looking pretty good. But we still have challenges ahead. The next year is not going to be easy. It's going to be different than this year, but it's not going to be easy. And so I know there's a lot of people excited about the vaccine. I'm not going to spend much time on COVID. I'm kind of over trying to predict COVID. We just got to kind of move forward, because I think it's something that is maybe wasting a lot of mental energy. So this is a little bit of what we call the investors, kind of, I guess, following their emotions and what this kind of emotional cycle looks like, right? So you have this kind of baseline of we're optimistic, right? But sometimes what happens is we turn into where we have elation, where we're overly optimistic, where we feel like we're so excited about what's happening. And that's generally a market tops. So when people are super excited, when they're in this elation phase, then that's when markets tend to peak out. And then we get into this decline and people start getting nervous. And then that actually breeds fear. And then you start this cycle all over again. So we really lived through this this past year, where we started the year with optimism. By early March, markets were doing pretty well, and then we started to go through this downturn. We had massive amounts of fear in April and May, and we came out of this, and now I think optimism is back. I don't think we're at the elation phase yet, but definitely optimism is back. So trying to control the emotions is a big part of being a good investor, is just being disciplined. And I do think that as we look back at a year like this year, part of having discipline is how you get rewarded, or the stock market returns are how you get rewarded for having discipline. And it's really important to remember that. And you cannot predict the future, or at least you can't predict the future on a repeatable basis. We can all be right once or twice, but it's hard to be right all the time. And so again, having that discipline, taking the emotions out of it, that's why we spend so much time financial planning, because I can sit across the table from a client, and if we know their financial plan, if we understand their cash needs, if we understand what they need to run their family over the next 1 year, over the next 5 years, over the next 10 years, we can create an investment plan that takes all those things into account, even the volatility, because we don't know when the volatility is going to arrive, but we know it will. We know sell-offs are coming. They're going to be here forever. So when you look at an investor span, if you're 50 years old and you're going to have another 40 years on this planet, you're going to probably go through, unfortunately, another 7 to 10 of these over your lifetime. So part of being a good investor is understanding that's going to come and being disciplined. A big part of what we do, I'm not ready to go that. Big part of what we do is we make sure we rebalance accounts. So rebalancing accounts when we go through these really volatile periods basically means getting our accounts back into alignment. I spent some other times in previous webinars going through this. We actually made 2 significant changes this year. We rebalanced the accounts in March, April, and May. Every client was a little bit different, March, April, and May. And then we started rebalancing again. And we've been doing that for the last 6 to 8 weeks, because there's been so much volatility that our client accounts got out of alignment. So when the markets go down, when we rebalance, we're buying into the stock market. When the markets go up, what happens? We're selling from the stock market. So the rebalancing discipline, by definition, allows us to, in a difficult market, we're buying low, and in a rising market, we're selling high. Now, maybe not the highest, but we're selling high. And that's the discipline that we put in place for our clients to make sure we can maintain the appropriate diversification. So one of the things we are going to talk a little bit about is the importance of diversification. We're having a year where, pretty crazy, but the majority of returns are concentrated in the 5 largest stocks. Now, this chart is a little bit dated. It's about a month and a half old. So this was through the end of October. Now, since the end of October, post-election, the results have improved, because if you see on here, the S&P is up 1% for the year as of this date. It's now up 15%. So from this chart going forward, the rest of the stock market is kind of caught up in terms of not being concentrated in just 5 companies. But think of that. Up until this point, 38% was the rate of return for the top 5 companies, and the bottom 495 lost 6%. So when you talk about, one of the best tenets of investing is diversification. Look at this. If you would have just owned the 5 technology companies that we're all familiar with, you would have had a great return in a pretty difficult time, and being diversified would have got you in a negative result. So pretty amazing when you look at the concentration of what happened this year. This is definitely an anomaly, but it does happen from time to time. Another thing that that's pretty remarkable is if you look at the impact of these 5 companies on the entire market. And so what we're looking at here, there's a term called market cap, and that just measures the size of these companies in the overall market. And this is looking at what percentage the top 5 companies are making as comprise of the S&P 500. So the top 5 companies, what percentage are they in the S&P 500? So as of right now, they make up about 23%. Back in 2000, the top 5 companies made 18%. The average is around 13. So what's pretty fascinating right now is obviously these big companies are getting bigger and bigger and bigger and bigger. Now, that's not necessarily a bad thing. We all know those companies in this space, whether, we're not here to promote companies, but the names in this space are Apple, Microsoft, Google, Facebook, and I believe Netflix is the 5th on here in terms of looking at the overall performance. But if you think of that, I mean, it's pretty remarkable when you see these numbers and you see the fact that these large companies are becoming a bigger and bigger player. And it's because they're dominating. Excuse me, I don't think I said Amazon. So Amazon is the other company, not Netflix. So when you start looking at this dynamics, this is rare that you have this level of concentration, but it has happened in the past. And if we actually go back into the 30s and 40s, there's actually periods of times where it was a little bit higher. And that was back when AT&T was the only telecommunication companies before they got split up into all the baby bells. AT&T was a much bigger player and made up, was a giant company relative to others. So let me give you kind of an update here on what we're looking at in terms of some of the numbers. This is as of Friday. So I highlighted here in green a couple benchmarks that we want to look at. Now, these are just indexes, but it's just designed to give you a little bit of flavor for what we're seeing. So there's an index called the Russell 1000 Growth, which is basically growth companies, which are the companies like are the industries like technology, consumer discretionaries, healthcare. That tend to make up the growth sector. And then the NASDAQ, which is obviously the companies that trade on the NASDAQ, which tend to be more tech focused. And if you look over here, the year to date, so YTD stands for year to date. So year to date return of these 33% and 39% respectively. So obviously performance has been really good. And if you look down here and kind of what I'm highlighting with the cursor, year to date performance of the growth sector of the U.S. stock market. So the L, M, and S represent large, mid, and small. So large companies, medium-sized companies, and small. And look at the growth. Up 33%, up 31%, and up 29%. So we're looking at most of the returns that are coming from this growth part of the market, which are really kind of the technology companies of the, shut the economy down. How do you function in a world where the old line industries can't function? And that's really benefited the growth sector. So if I remove those and then we say, okay, well, let's look a little bit of, okay, well, what about over the last 3 years? So if we're just looking at this 1 year, let's look at the last 3 years. So the last 3 years, and this shows cumulative performance. So that would be compounded performance. So the Russell 1000 growth over the last 3 years made 79%, so almost 80%. Russell 1000 value, which is large company value stocks, which tend to be more like energy and industrials and utilities and financials. You can see they've cumulative return is 18%. The international markets, 14, and the emerging markets around 22. So over not only this year, but over the last 3 years, the performance for growth has been staggering and has been much higher. So, and if we look at value for the U.S., look at these returns. I mean, these are really low when you compare them to their growth counterparts. So the value, large value, mid value, and small value, up 1.3%, up 2.7, and up 2.3. Now, why is this significant? Well, when we build portfolios, we're diversifying assets across all of these areas, right? So, we have parts of the portfolio that have done amazingly well this year, and we've had parts of the portfolio that have struggled. And it's really important to maintain diversification, even though when you look at this, you're like, why do I want to sign up for this? And I'm gonna kind of build the case for why you want to, because leadership tends to change, and you want to maintain balance, because balance is where over time how you do well. So this data actually goes back to 1928. And the data we're looking at here is when you're comparing value versus growth, history is actually on the side of value. So even though that chart that I just showed you showed that large growth over the last 3 years is up 80% and large value is only up about 20, over the last almost 100 years, value has actually outperformed growth by on average 4.5% per year. Now, that's past performance. That doesn't mean it's going to continue, but there are reasons why leadership should change, and you're not likely going to have one category continue to do better in perpetuity. Leadership tends to change, and a lot of people are telling me, "Oh, it's different this time. Technology is here to stay." Well, of course, technology is here to stay. I mean, technology's been here to stay forever. There was great companies back in the '80s that were all tech focused, and so yes. The technology markets, the consumer markets, based on like Amazon, those are all dominating industries. They're changing the way the industries are put together. But a lot of these companies are actually, getting more expensive, right? Because they've gone up in value. So this basically just shows charts. So what we're looking at here, kind of the green bar chart, shows when value outperforms growth and by how much. And then the bottom says when growth outperforms value and by how much. And so you can see on the side, we have 0 to 10%. And then up here, we're looking at 10, 20, 30, and 40%. So the last time that you can see where value really outperformed growth for a while was around 2000, 2001, 2002. So almost for about 7, 8 years where value outperformed. And so again, this is just going back, giving you some historical data on reasons why we want to maintain balance. We still believe that there's a place in portfolios for value and growth. It's not one or the other. It's really creating a diversified strategy. That's how we manage money. It's not one or the other. But we do start seeing bad habits where people only want to own growth. And then we think that's a big mistake. And we don't run models that way. So let's talk a little bit about what these numbers have been over the last 10 years. So this is ending. I went in, I was doing some research preparing for today, and this data was from Russell. Russell Investments is a big investment firm. They actually build these indexes, but they're a big investment shop. And they did this study that ended through March 31st of this year. And honestly, if they would have done it through the end of this year, they probably will update it through the end of this year. The numbers that favor growth are even bigger. But if we look at what we're looking at here is that, let me read through some of this because it's significant around the concept. So the large growth category has actually returned 257% over the last 10 years, right? So that's a fantastic rate of return, 257%. Now, when we look at these other categories, I'm not going to spend a ton of time on, large value or large core. I really want to emphasize in this conversation is the difference between the large growth category and the small value category. So what we're basically looking at here is that the large value category underperformed large growth by 134%. So if you did the math really quickly on that, that would mean that small cap value companies have earned over 100% over this past 10 years, but relative to growth has been a lagging investment, right? So you can see how substantial that is. Now, when we look at the period that ends in 1999, so we all remember the end of 99, right? That was Y2K. That was, now in hindsight, it was the start of the dot-com bubble burst of the technology peak. And when we look at that 10 years, one of the things that we're not having too much conversations with clients. I think this might be more of a conversation we're going to have next year. We have a little bit of this with our younger clients who kind of look at technology as the only place to invest. They're really looking at is, do I want to rethink being diversified? Is it time to jump on the large cap growth story and abandon small value? Is it time to abandon to abandon our diversification discipline? And when you look at at this period, so this was essentially looking at, at the end of 99, it's almost the same story. So look at what happened here is over this period of time, growth outperformed dramatically. I don't have the number on growth, but growth over this period was up over, I think, 500%. If you look at small value, same kind of thing. It underperformed by a significant amount. So that's where a lot of the hot money was flowing, was into this growth part of the economy, and especially large growth. So that was ending in 1999. So now as we start looking and saying, okay, you know what? The 90s were a great run for US stocks. They did tremendously well. This was right around the time I was starting in the investment business in the late 90s. And growth was kind of all the rage. But you know what? All stocks did pretty well over that decade. And when we start looking at this idea of abandoning diversification and versus having discipline and rebalancing, let me show you what this next period looked like. So now we're going to look at basically January 1st of 2000. So right at the end of the turn of the century, and the next 10 years. So this is the period we're going to look at. So you can see it's basically following 12/31/1999. And looking at where we are today. So if you look, the next 10 years following this pretty remarkable period is that large cap growth stocks lost 4.8% per year over this 10-year period. So they lost. So 4.8% per year for 10 years. I don't know the exact numbers on what that loss is, but it's a substantial double-digit loss over a 10-year period. This is a little bit referred to as the lost decade. Well, the lost decade was really a lost decade for growth stocks. But if you look at the rest of the categories, now value arguably on the large side didn't do great either, but look at small value. Small value was up, was 238% better than large growth. So really looking at the last 2 years, you can see where one decade was defined by one style of investing being way in favor. The next decade where that really flipped on its head. And it's a matter of, and there were plenty of people that abandoned. I remember reading articles about how value managers would talk about this thing called career risk. That the career risk is that if they stay disciplined to what they're going to do, they run the risk of getting fired. Because when you come out of a decade where one style of investing is so in favor, then in the next decade it switches. If clients don't maintain discipline, then you run the risk of getting fired because you're diversifying assets, right? And fair enough, I'll have questions with clients. It's like, why don't you just move, right? Why don't you, if growth's doing well, we'll stay there. And once value starts doing well, we'll move. Well, that's easier said than done. We don't know how these decades are going to fall. We don't know how the years are going to fall. Now, this example, we can only do it with hindsight. We don't know what the future holds. Now, I am making the case that because the last 10 years has been so good that, you know what, for the next 10 years, I do expect there to be a little bit better balance. I think the outperformance will come down. My expectations are that small value will do better. But at the end of the day, we think the US markets are going to do fine. In all cases, we want to maintain balance because it's impossible for us to predict the future. The data suggests that should change, but it doesn't have to. And that's why we're not saying we want to get out of these big tech companies. We still think they're going to thrive. They're still going to be a big part of our portfolio. We just want to make sure we maintain balance and maintain discipline and don't abandon that, because unfortunately, that's what we see a lot of. So as we look at kind of the history, so I think I highlighted this internally. It's a little hard to see on my screen, but if you look back over the last 40 years, even though large growth has done so much better the last 10 years, small value still has a slight edge over the last 40 years, about 11.4 versus 11.1. Now, frankly, I think any of us would take both of those numbers over a 40-year period. But if you look at the chart below, this actually takes us back to 1930. So this is data put together by Fama and French. You can see the data going back where it really favors value. It favors small cap value. So again, we do think this over time will manifest itself in this similar way. When that's going to change, it's anybody's guess. we don't know. We're not predicting that. Again, part of our discipline that I talked about earlier is rebalancing. So if I want to have, asset spread in these different 4 quadrants, when one's doing a lot better, what do? We trim and we take profits and get it back into balance. And what does that mean? It means we're buying things that are out of favor. We know over time, if we do that methodically over a 5, 10, 15, 20-year period, that's going to help our clients kind of smooth things out. And so that's really the approach that we're taking. Now, again, my prediction is that things are probably going to start to turn, but that doesn't mean we start overweighting one area and really not employing a discipline around rebalancing and maintaining diversification. Because at the end of the day, we don't have a crystal ball. Nobody has a crystal ball. If anything should give us humility is this year. This year was a reminder of anything goes. Things that you thought probably at the beginning of the year could never happen, probably have happened. And the outcome that you expected from your investments, both stocks and real estate, continuing to push higher, surprised a lot of people. I know if you've been tuning into the webinars, we've said pretty much early on with what the Federal Reserve was doing and the government was doing, that was going to bode well for economic stability as well as markets going higher. Unfortunately, because of political reasons, we're not getting more stimulus passed while we're having another shutdown. So that's going to present some challenges here as we go into year end and into the first quarter. But a lot of this is, it is noise. It's not noise because we're living through it, but it's noise from an investment perspective. And those are the two things we really have to separate. What our money is doing with a long-term strategy should be totally disconnected from how we're living our life or how we're feeling emotionally or what's happening. They should not be connected. And unfortunately, that's really the downfall of a lot of investors, is they tie the two together and then it shapes the decision-making. And that's honestly why we get hired, right? Is to have that discipline in place. I hope we're not being hired for a crystal ball, because we don't have one. Like we know through discipline and good decision-making, that's how we're going to make a difference over time. So I know this is a long kind of cadence. Hopefully it built up to really the story that we wanted to talk about, is that there has been times where we've seen this pattern emerge. And again, I'm not predicting that we're going to have a repeat of what happened in the early 2000s, but we do want to have that reminder that leadership can change even when it just seems improbable. So when we look at, what should we be thinking about in positioning equity portfolios? So these are just kind of 3 questions that the Russell article really kind of pointed to, is will the large cap growth trend maintain its momentum? And it is possible that it'll continue. If you look at these companies that are dominating, these are the best brands in the world, right? They're dominating so many areas of our life, of our businesses, that it could continue for a while. But we do think, based on experience, that maintaining a balanced profile between the value and smaller cap and making sure we maintain balance is really important. Even if we think this momentum is going to continue, to still maintain balance. One of the other things that from a portfolio positioning is coming out of recessions and potentially a market bottom. Usually, and when I say usually, over the last 40 years, we've had these recessions or have had 30% market corrections. Over the last 4 occasions, smaller company stocks have tended to outperform larger companies. So that's just a trend that has happened. Doesn't mean it has to repeat, but the last 4 times that did happen. And then in terms of the other interesting dynamic is, how should investors think about active versus passive? So active means there's a portfolio manager making decisions. Passive means it's an index. And for those of you who have been having meetings with us and looking at how we've been shifting some of the allocation of our portfolios, we've been adding to more active managers. Now, when you add to more active managers, there are some higher costs, because you have a portfolio manager who's making decisions, and therefore you pay a fee for that. But what we've seen with that is those managers tend to be more concentrated. By more concentrated, they're more selective. And if they do their job right, we've seen that they can deliver some really solid results. Again, and we can't promise past performance, but as we start reviewing your holdings, in our review meetings as we go into next year, we'll be able to pinpoint and show you some examples of that. And so we've kind of shifted, and we think this next decade is really going to be an environment where active managers are going to be in favor. And we think, unfortunately, too many investors are in passively run indexes through their 401ks, through money at Vanguard. And while we do believe that's been a very good story the last 10 years, we think the next 10 years, people should start thinking about diversifying that idea. So if they're Passive only, meaning they only want to do index, start introducing some active managers. We think having a combination of both in the portfolio over time are gonna lend to some pretty solid results. So, and historically, when we look at this kind of environment, it tends to bode a little bit better for more active managers who can be more selective, right? They can look at industries and companies that they think aren't going to make it out of this pandemic, those that just have more of a closed mindset, that aren't able to adapt, that aren't really looking at growing and are going to get stuck in their old ways. Those companies are not going to thrive and they might die. So the beauty of looking at more active managers is you get someone who is going to be making decisions on what companies to invest in and what companies to avoid. And so those are all things and kind of themes that we're putting in the portfolios. And I know those things are important to you because you asked, like, how do you construct portfolios? And that's what we do, you know, when we're considering these things for you as clients. So let me just check. I'm going to pause on this slide right here. And because I want to get into, as we kind of summarize, looks like I might have a question. So let me take a look at this. So question I have, it says, commercial property is taking a hit due to the virus. What are your thoughts on REITs as they will take a serious hit? So good question. So commercial property, so let's kind of unpack that question. So let me move this out of the way. So REITs are real estate investment trusts. So basically what a REIT is, it's a publicly traded company. So it's a stock where their business is as real estate investors. And so as a real estate investor, they can buy mall properties, apartment buildings, industrial facilities, manufacturing facilities, you know, warehouses for Amazon. They can own hotels. They can own cell towers that own the real estate and the towers on there. They can own public storage real estate. So the first thing is not all REITs are struggling. There are pockets of REITs that are struggling. The big ones are commercial in terms of office. Office is a category that is hurting right now because you have people working from home. And I also think you have businesses rethinking, do we need the space? Can we be more effective with maybe a more flexible workspace? Can we be more flexible, or can we be more profitable with having some of our workers work at home, maybe not commute, have more time? So the commercial space is going to be challenged, but at the end of the day, pricing is reflecting that. So that part of the real estate market has actually already come down. Hotel properties have come down. You know, things that have done really well, apartments have done really well. Manufacturing has done really well because there's a big push towards a lot of these distribution facilities like Amazon is building all over the country, right? So number one, real estate is not all created equal. We have a real estate part of the portfolio. We think it's going to do extremely well because, you know, we still have a massive consumer that is consuming food. Now, just think about all the retail around us that's more businesses, you know, those that are delivering food, whether it's fast food or fast casual, or a lot of the local places like even Target or Whole Foods Market, places like that. We still need to have local businesses. We can't have all of our food delivered elsewhere, right? Because if we're not going to go in and do in-store dining or in restaurant dining, then we're going to need that restaurant close to our house so we can have hot food. So we still think there's going to be some pain in the real estate market. Those that took on a lot of leverage, that's going to be a lot harder for those areas. But there's plenty of areas that are doing well. And the other thing is, you know, on the real estate side, especially the personal real estate side, you know, the cost of building, the cost of materials, the cost of people continue to go higher, which is one of the reasons why it's pushing prices higher, as well as interest rates are, you know, historically really low. So the cost of borrowing is really inexpensive. So yes, real estate's going to be a little bit more challenged, but I don't think it's as doomsday as people think, because, you know, we're still a growing population. You know, we still have people that are continuing to, you know, I guess we have a net positive population. So we're still going to need more real estate, but we got to be a little bit more particular, especially in the commercial space that you mentioned. So sorry for the long-winded answer. Hopefully that was helpful. Okay, so let me deal with just a couple of things. You might even have heard this from us that, you know, what's the next 20 years going to look like? It's hard. We can't predict that clearly. But we kind of have an attitude that says, you know what, we think maybe returns are going to be lower than expected. So if we look at the last almost 100 years, returns for the markets have averaged, north of 10%. So by us saying we think maybe they're going to be a little bit lower over the next 20 years, well, if it's at 9, is that big of a deal? Now, the one thing that this chart is actually showing us is some really amazing history. And so I want to spend a little bit of time making sure you understand this chart. So on the left-hand side, what we're looking at is a chart, and this orange, I believe it's orange, this orange chart, it might be red on your side, but this orange reddish color shows the past 20 years. So if I took a snapshot right here in 1950, right? If everyone sees this as October 50, that the market had averaged 1.9% over the previous 20 years. Well, think about that period in time. 1950 takes us back to what? 1930, which is the start of the Great Depression. So it's no wonder why that 20-year period was actually pretty low from a rate of return. Now, when we go above that and we say, okay, well, what's this yellow chart saying? This yellow chart is saying from that point forward, what were the next 20 years of returns? And the next 20 years of return was actually 14%. So what this shows is that when you have low past performance, that the next performance tends to be higher. So let's fast forward to more recent history. We had that stock market peak in March of 2000. The markets had averaged from March of 1980 to March of 2000, 18% per year. Now, if you've seen any of my other presentations, that was the single biggest wealth accumulation event that our country has ever seen. The stock market compounding at 18% a year for 20 years. And the Dow or the S&P went up, I think, 11 times or 12 times. So that means $100,000 was worth 1.2 million over a 20-year period. Remarkable growth. Well, but then let's look what happened. If you had invested in March of 2000, at the end of this really great run, the next 20 years, you averaged 4.8%. So what this chart is showing you, and I truly believe this as a key discipline or a key tenet in investing, is this idea of reversion to the mean. When you have really high long-term returns that are higher than normal, higher above average, right? If average is 10 or 11 and you get 18, that means the next period of time is going to have to be lower to average it out. So the good news for all of us that might have some optimism about the future is that if we look over the past 20 years, as of October, the average 20-year return is 6.3%. Well, the yellow chart hasn't filled in yet, so we don't know what this is going to be when we look back. My guess is it's going to be higher. And so if you look over on the right-hand side, it basically just shows it breaks down two periods. Periods where the past return was less than 8%, and then periods where the markets were greater than 14%. And then it identified, well, what was the return the next 20 years? So in the scenario where the returns were less than 8%, the next 20 years averaged 14.8. And in the scenarios where the returns were greater than 14, they averaged only 8. So the message really is there, and I know I'm kind of going slow and harping on this, is that when past tends to be below average, the future tends to be above average. And that's the thing, is I think, unfortunately, the psychological part of us is we tend to forecast is that if the near term is low, we project the long term to be low. And when the near term is very high, we tend to project that the long term is going to be high because it's going to mirror what reality is. And in actuality, that doesn't happen. That leadership tends to change, and that high returns over a period of time are not going to be sustainable, and they have to revert back to this average. And again, that's called reversion to mean or reversion to average. So given this, that's where we have some bullishness over this next 10-year period, next 10, 20 years, that the markets are going to do just fine in spite of all the negative headlines that are out there. Okay, another thing is that we've had to have conversations with clients about is, well, why don't we just have all our money in the US? Why do we need any overseas exposure? Well, the main reason is there's some great companies outside the US, and it makes sense from a diversification to have exposure. So that's on the surface. I could give you plenty of scientific or some research-based an analysis that really proves that point. But this one is just more here and now. So let me deal with today, or I guess over the last couple of months, where we are. So if you look at this chart, this goes back to 1980. And when we're above the line, this means international stocks outperform, and by how much? And then, and this is on average. And then if you look at below, when it's below, is how much US stocks outperform. So if you look back February of 1999, which arguably is right at that time of the turn of the century, not quite at the end of the year, but the US stocks outperformed international by about 13%. Now, where we stand today is that US stocks have outperformed international by about 9%. So when this has happened, so if you read this box over here, is international outperforms after extended US run. So after the US has had a really nice healthy run over a 10-year average, so this is the 10-year average, the average annual outperformance of international stocks over 10 years, whenever US stocks have outperformed by greater than 8% for the last 10 years. So that shows that there's likely going to be a built-in advantage for some of these overseas companies for a couple of reasons. And the big one is because of valuations. When things tend to be a little bit cheaper or lower priced, they tend to have an advantage to grow a little bit faster. So what's pretty fascinating with this, though, is how long these cycles last, right? International outperformed for a while, then US outperformed for a while, then international had its time, and now US has had its time. So we think this is going to start to shift back now. In all fair disclosure, we've been talking about this with clients for the last 4 or 5 years. And so we do believe this will change. The timing of it, we just don't know, right? Just because we have research on this doesn't mean it just flips a switch and goes. But again, that's why we have balance. That's why when we have portfolios and US stocks are doing better, that we're rebalancing and bringing things back into alignment so that eventually when the international markets start to regain some leadership, we'll have some exposure there. But we tend to be, down in the 20 to 30% range, our international exposure. So while we do have a nice balance towards that, or a nice allocation, we still favor US stocks long-term as a core part of our portfolio. Big reason is we're for the most part, we're all US citizens. And so it makes sense to have a home country bias. All right, there's a lot on here. Just want to last few here as we wrap up. Check my time. We are good on time. This is a diversified portfolio can work even though it never feels good. So let's kind of walk through these lines. So when we talk about a diversified portfolio, you can see kind of what would be in a diversified portfolio: 40% in US stocks, 10% international, 5% in small company, 5% in emerging markets, 30% in US bonds, 10% in high yields. Now, when we talk about balance for our portfolios, it does not mirror that. This was just more for an example. There's some similarities, but it definitely doesn't fall into this. So I don't want you to think that this is what our balance means, but it was just mainly to illustrate a point. So if we look at, and we're going to take some periods of time, we're going to go back over the last 20 years, from 2000 to 2002. Now you can notice there's some disclosures on here. So in some cases, it doesn't mean the whole year, but from 2000 to 2002, the S&P lost 18%, a diversified portfolio lost 7 or 6.8. And your response as an investor is, I lost money, right? That's the emotional part of this. Then the next cycle was from 2003 to 2007. The S&P was up 82.9%. A diversified portfolio was up 80. And your emotional response is, I didn't make as much. All right, fair enough. Then in 2008, the S&P lost 37%. A diversified portfolio lost 24. Your emotional response is, I lost money. Now, the next period, this is a 10-year period or almost 11-year period, from 2009 to 2019. The S&P made 351%. A diversified portfolio made 195. The feeling is, I didn't make as much. Then right as this is kind of 2020 broken out into pre-COVID, or I guess in the middle of COVID and post-COVID recovery, is the market, the S&P lost 30%, a diversified portfolio lost 20. Our emotional reaction is, I lost money. Then in the recovery, the S&P's rallied almost 52%, and a diversified portfolio has rallied only 30. And that emotional feeling is, I didn't make as much money. Now, when we look at the 20-year cycle, then we say, okay, the S&P was up 247%. A diversified portfolio was up at 253. So this slide basically is designed to illustrate that diversification can work even when it feels like it's losing. So even when it feels like each time you're measuring, it doesn't measure up to what you feel. And that's kind of the challenge with the emotional piece of investing, is that we all feel that it's natural. But this is a long-term game. We're not investing. We're not investing with a one day time horizon, or a 1 month time horizon, or even a 1 year time horizon. We really want to look at how things play out over a meaningful period of time, because that's where we can have more success and a little bit more predictability. So hopefully that makes sense. A lot of information in there, but hopefully it makes sense. I mean, really, this kind of helps to illustrate the emotional part of decision making, the emotional part of diversification. So I am wrapped up. So as a reminder, these are our core values here at Vance Wealth. These are the things that as we, as new clients hire us, we hope they embody these and truly take these things to heart. This is what makes up our Vance Wealth team. So lucky and fortunate to be surrounded by so many great people. As we start going in and, as we're wrapping up the year, we've had a really good year. Financially, from how our client accounts have done, how we have done as a firm. We're growing. We hired 2 people this year. We're likely going to be hiring probably 2 more people at the start of next year. We're definitely want to grow smartly and to be able to accommodate your needs. We're continuing to add really high quality people, and hopefully you feel the same way. Just know that, when we put together our plan, it's always with our clients in mind. The reason we grow is to make sure our service never suffers, and we want to make sure we're here, we're available. This has been a really unique year for me. I haven't been able to see and talk to you face to face in a lot of cases. I know we've done a lot of Zoom meetings, but I have enjoyed doing these webinars. It's been kind of the highlight of the month for me to kind of prepare some fun topics and be able to share with you. And just know, while we are growing, we're here to help. So, as you, our clients tend to be our best advocates, and, we're here to help people that are important to you. So if you have anyone that, you don't think had the experience that you've had this year with us, this year with your financial planning, keep us in mind. We're happy to help them. We're always a good place to start in terms of, giving them a complimentary consultation. So we always appreciate referrals. They really are the highest compliment. So, thank you for all the trust and confidence you put in our firm and each and every individual here. And just a couple of quick things as we wrap up. If you're not connected with us on Facebook or LinkedIn, that's where we post a lot of information. We're also pushing it out through email, but please like us on Facebook so that you can see updates that we're posting. Additionally, a couple things. We are going to do our annual market and economic update. So it's sad for me to say that this is going to have to be virtual, even though I have been accustomed to doing our webinars. This will be the first year and probably 15 that I don't get to do it live. I'll try to bring the same amount of energy that I bring to this. Might be a little bit longer. It depends on what we're going to go through. I wish I could find a way to replicate your questions and your presence, but that's going to be on Tuesday, January 19th at 4:30. And then we're also doing a chamber webinar with myself and Lisa Odom, just kind of covering some business related issues on how to set up your business for success in 2021. So that's it. So I hope you enjoyed this. If you have any feedback, let me do a quick thing. No Q&A. So I hope you enjoyed this. Please stay safe. I hope you have a wonderful holiday season with your family. And if there's anything we can do to help, you know where to find us. Thank you.